Welcome to Strategic Alternatives, the RBC Capital Markets podcast. In today's episode, we're listening in on a conversation between Amy Silverman, head of equity derivatives strategy, and Ben Fisher, U.S. equity sales specialist, recorded at RBC's Global Financial Institutions Conference in New York. Amy and Ben discuss the forces shaping market volatility today, from geopolitical tensions and energy market uncertainty to the shifting outlook for software and private credit. They explore whether the VIX is truly reflecting the risks investors are navigating beneath the surface and what could trigger a move to a more sustained, high volatility environment. Now, let's dive into the conversation.
So, Amy, I want to start super big picture. There's a lot to talk about, but real simple question. Do you think the VIX is representing the real risk out there right now, or do you think it's underpriced? And if so, what are the ingredients that you would see for the VIX to kind of break out of this kind of 5-year range that we've seen?
Well, it's great to be here with you, Ben. And it's a great question to start with because it kind of frames a lot of the angst that we've seen under the surface. Year to date, the S&P is still only down, like 1.5%, under 2%. It's really stunning when you sit back and think about it because there's been so much headline risk. There's been so much noise, but we've been saved to some degree by this zigging and zagging that's in the market. So you might have software getting destroyed, but then you'll have another sector that's doing well. Some people call it halo, maybe defensive cyclicals. But the point is, all this has been going on under the surface. It has not really impacted your index level volatility, which at the end of the day, the VIX is just a weighting of S&P implied volatility. And that's why, even though we got to that 30 handle during the headlines in Iran, it's still been fairly muted. And we've still kind of fairly followed the playbook of essentially what happened with Russia-Ukraine. So perhaps we're announcing that the war with Iran is over, but I don't know if Iran agrees with that or not. And so the point is you have volatility following this kind of 5-year playbook of folks are fading it because geopolitically that has been the precedent. That makes sense. And I understand people's inclination to go there. But you do have this risk that this dispersion, which has really helped you structurally, is not going to stay with you forever. And so I do think we need to watch for that spike in correlation.
What would you be watching where you're just like, okay, we're going back to that real volatile environment, back to a 40 plus VIX? What would make you worried that that's going to happen?
Maybe I'll start with the fundamental risks first, which was let's just take the whole geopolitical situation out for a moment. Even prior to Iran sort of being the top of the news headlines, we already saw issues with software, obviously, with a lot of investors asking the question, what happens when terminal value is existentially questioned? You did see options, especially on the downside, really reflect bearish sentiment. It's just that because there were other sectors that were reflecting bullish sentiment, you had that relatively subdued index level volatility. Now, I would say from here, those still remain questions, but on top of that, there are going to be real impacts, even from the short time where we've had issues in the Strait of Hormuz, even from the short time where we've had kind of bleed-on effects from the temporary spike in correlation we've had. And then outside of that, I think there's a longer-term arch of what does this do to rates action in play and what does this do to longer-term growth and inflation. So I think they're all still there. You have seen a decent amount of monetization of folks who were long hedges and they've monetized that. It's very much the 2022 playbook. However, there is this little bit of complacency because the other thing people remember about 2022, this is my favorite stat for a long time, was the market drew down about 20%. But a systematic put buying strategy actually drew down 21%. You probably remember me saying that back in 2022. And so there is this, again, this fear that we're going to underperform on these hedges. That's why they get quickly monetized.
You've been saying for a while that people have been more fearful of that right tail FOMO chase than they have of the left tail downside chase.
Yeah, I think that's part of it. And then maybe let me ask you a question, Ben, because you've been at the financials conference where we're doing this podcast from, and you mentioned to me off air that you were just at one of the BDC meetings, which I guess is the hot ticket this year, not so much in the past few years. So I'd love to hear from you what you've been hearing from companies and from clients and just what the sentiment is just right here at the conference itself.
I think the worry is what the CEO of Citigroup, James Fraser, said was, look, right now, like all these macro worries in isolation are not really affecting like growth numbers, econ growth. Like we don't see it in credit markets, which would be like the real worry. But she's like, what happens if the AI angst, the private credit angst, and then the Iran angst all kind of converge at once? Then you probably get that big drawdown. The clients I speak to, obviously, this like extreme volatility has made it difficult to make money in, quite frankly, just because of the rapidity of the moves and just the quick nature and just having to be forced to trade headlines.
So maybe a follow on for you. Software obviously took a huge hit, and the IGV is down substantially, probably one of the worst performing sectors year to date, unlike the S&P. How are you thinking about that now when you have conversations with research analysts, with clients? Are people getting out their shopping lists, or is it still wait and see? The angst is presiding over everything?
These risks are real. Like if you look at Anthropic's numbers, if you look at OpenAI's numbers, and the fact that they're private and they can just kind of give these like big picture numbers, like makes it more difficult. But they are accelerating growth like meaningfully. So these risks are very real. I will say that the sentiment has gotten better within software, and these OpenAI models, they need software, and they're just like, look, the whole coding aspect of software, like we already assumed that was going to be commoditized out to zero, but they're going to need to partner with software companies if they want to succeed. But as you know, narrative over reality oftentimes drives stocks and volatility more than anything. And right now, it's just a matter of convincing investors that this terminal risk issue is going away, which is very difficult to do. But it is interesting because I still get a lot of skepticism on software, and that kind of makes me feel like the recent software rally probably has legs because almost to a man that I talk to or a woman, they think that the secular risks are still out there and they're still pretty negative. And ultimately, price drives investing. And if they'll start to get a FOMO rally like kicking in, and they'll have to reallocate to the sector in some way.
Yeah, maybe I'll share an interesting historical study that we did on this topic, because when the initial software sell off happened, there are all these headlines that software is essentially your newspaper stocks of the internet era. And the interesting takeaway is from the late 90s, it took most of the newspaper companies until almost 2008 to be fully disrupted. To me, that's just so much longer than I think you would have intuitively said without going back and looking at the data. And then there are very specific instances. So I'll give you one, the New York Times, where not only is this company currently trading at all-time highs, they managed to transition themselves. So yes, they were a newspaper, but now what are they? They're a podcast, they are a game app, and they're digital. And there are other companies where the slew of M&A I thought was so interesting. There was a slew of M&A. A lot of these companies actually got taken out privately, and these companies actually got taken out at premiums. Now, what was interesting is the companies that then took them out themselves had bankruptcies, but it was sort of like you did have opportunities to make money. And maybe the final thing I'll say on this that I think is counterintuitive is we kind of ask the question, well, what happens to the volatility of these companies, right? So if there is this existential question that terminal value is perpetually at risk, then to some degree, there's no earnings that can save you. There's no near-term catalyst that's going to fix the problem that fundamentally people are worried about your ultimate DCF, right? But what's interesting is because a lot of these companies became takeouts, your terminal value was actually assured, not highly volatile. So the term structure and the volatility of these companies ended up being the opposite of what you would have intuitively said, because ultimately they became takeout candidates. And usually in a cash takeout, your terminal value is actually assured. So I just thought that was really interesting food for thought, because when people tell me software is the next newspaper, I say, well, okay, that might be true, but a lot of newspapers ended up making money until the great financial crisis.
Just sticking with that for a second, though, what is the options market signaling for software companies, and if you have it, like for the BDC private credit players?
I think to some degree, the market and the narrative got a little lost because obviously Iran became front and center. But what had become very interesting is essentially what we do is we'll take the different BDC constituents. So for instance, in the BDC ETFs, and the same thing for the constituents of the IGV, and we just say, where are normalized skew levels now versus a year ago, 2 years ago, 5 years ago? And so that's essentially asking the question, like, where has sentiment gone? And prior to, I'd say, Iran being the headline news, they were all bottoming. I'd say the pushback from clients would be like, well, Amy, of course they're bottoming because the stocks are down so much. Like, usually when the stocks are down so much, there's like nothing left to hedge. We've already had the drawdown. I would tell you that's not necessarily true. So, meaning when we had that first initial drawdown in IGV and the constituents, skew is still very high. And I will tell you right now in the market, even though we're getting a reprieve on the Delta side, on the S&P side, skew hasn't budged all that much. And it's the market's way of telling you through options that even though we might have some temporary relief, we're not like okay yet with the longer term issues. And what has changed recently in the last 1 or 2 weeks is that has become more the case for IGV, but it is still not fully the case in the BDCs. So I think that's interesting because ultimately we're talking about the same underliers, but they're very different asset classes. But in the IGV constituents themselves, you are seeing, I would say, the sentiment shift, but not so much yet in the BDCs.
Yeah, I think software bulls are probably wishing that this war will not end because I feel like it's everyone's attention has turned to kind of the geopolitical risks versus software, and they're buying some time. But the fear is once the geopolitical stuff dies down, they'll come back to the secular issues around software.
So maybe I'll throw a question back at you, Ben, because it's certainly been in the headlines. Are you in the camp of we've alleviated largely the concerns in the energy market with the recent comments on Iran, or are you more in the toothpaste can't go back in the tube, the eggs can't get unscrambled? I'd love to hear kind of the sentiment you're feeling from the desk and from clients as well.
I hear both from clients that one, like the risk is we now have like a structurally higher floor on oil. I mean, you can't put the toothpaste back in the bottle on a lot of things. Some more bullish are saying, like, look, if we can remove this player, Iran, who's been obviously a bad actor for decades, the longer term picture on oil, and obviously in conjunction with what happened in Venezuela, then maybe this has been like a secular change for the good. So near term, people are really just trying to figure out the duration of this war, because the duration of this war, if it continues, then you start to again worry about like the real economic data getting hit, like GDP getting hit, and then we start to get a growth scare, and then we get like a real drawdown. So why don't we end with, we can never have a conversation with Amy with Silverman without talking about the retail investor. Curious, like, obviously the retail investor has consistently and shockingly to a lot of people just bought the dip. Like, they just seem to have endless pockets and no risk event can dissuade them from buying the dip. So have you seen that in the options market, A? And B, what happens if they don't buy this dip? What does that mean for overall volatility and for market risk in general?
It's so funny because when I would say we were at the height of angst, so VIX hitting over 30 and sort of every day being news about oil and Iran, I thought to myself, retail's not going to buy this, are they? And I was wrong. Boy, was I wrong. It's just so fascinating to me because it's become so important, because it's become the most stable leg of the stool. And if you're an institutional investor, in the past 5 years, you have really had to reframe risk. This isn't even about some sort of outside kind of ad hoc actor. This is like you really have to reframe your distribution. And the way I would think about it is it's no different than when a company is deploying like a massive stock buyback, right? You've effectively cut off part of the tail because you have someone who's supporting it essentially through a put option. And this is what retail has become. It is so stunning to me. And I would say I would watch two things in the future. The first is, how do prediction markets start to influence everything and anything we see? Because I will tell you, as a derivative specialist, it's very interesting to me because prediction options were the goat. Options were the original prediction market. You wanted to make a prediction on something, you went to the options market. But now there's this more kind of specific, more marketable prediction market. And it's very interesting to me how that will begin to interplay with the actual options market itself. Obviously, the liquidity situation is very different. It's not somewhere for institutional investors to play, but maybe just a recall back to our volatility 2026 outlook, which was, I still continue to believe it's not something that scares away retail. It's something shinier that they might decide that they want to play with instead. That to me is sort of one risk. And the second is you just simply have a generation whose left tail anchor is different than ours. This is a generation whose left tail is arguably what, COVID? Maybe? And so what is the lesson? The lesson is you always own the right tail, and FOMO, MOMO is perpetually the more real risk. We saw it during this conflict with Iran. We'll continue to see it, and it's probably what is ultimately going to save our paddling duck.
Saying that the options market is potentially going to go the way of software and be replaced by the betting markets, or are you worried about that?
I think the options markets are going to start doing predictions. So it's essentially they'll do more binary options rather than having kind of the American and European style that's dominant today.
Can't beat them, join them kind of thing?
Maybe. if you build it, they will come. Zero DTE,
Well,
right?
That seems like a separate podcast. So we'll save that for for the next conference. Well, thanks for being with me, Amy. I'm sure we'll speak again soon.
Thanks for listening to Strategic Alternatives, the RBC Capital Markets podcast. This episode was recorded on March 10th, 2026. Listen and subscribe to Strategic Alternatives on Apple, Spotify, or wherever you get your podcasts. If you'd like to learn more or continue the conversation, please visit rbccm.com/strategic alternatives or contact your RBC representative. See you all next time.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.